The market had to respond to a surprise from the Federal Reserve, and this is not about a widely expected rate hike by 25 basis points. This move had been priced in by the market. The chairman's statements caught investors off guard. Jerome Powell delivered a message that at least one more rate hike is in the cards until the year end. From the viewpoint of the stock market, it's the worst-case scenario. Logically, the hawkish Fed's rhetoric could have enabled a considerable advance of the US dollar. In practice, the greenback lost ground across the board. Demand for the US currency went down a bit. Investors were astonished by the words about the lack of evidence of a recession in the US economy. Moreover, the Fed chairman does not foresee any signs in the future. In other words, if the economy does not reveal any slowdown, there are no preconditions for softening the ongoing monetary policy as soon as possible. All in all, the Fed's interest rates will remain at elevated levels for a long time. Such assessment of the economic conditions by the regulator contradicts the vision of market participants, and this contradiction came as a bombshell to investors. For this reason, the US dollar lost its footing. It happens that the Federal Reserve does not have an unbiased understanding of reality. This idea alarms investors and entails grave risks. From now on, everything will depend on the European Central Bank, which is widely expected to raise the key interest rate by 25 basis points to 4.25%. The market is ready for this policy move. In light of yesterday's remarks by Jerome Powell, investors attach more importance to the press conference by Christine Lagarde. Investors need to realize how the European regulator evaluates the current state of affairs and whether it's fully aware of economic woes. Previously, investors were more interested in accurately predicting the peak of rate hikes. At the present, they have shifted focus to the adequacy of further policy moves on the current economic conditions. Indeed, interest rates as such matter a lot to market participants in terms of borrowing costs and yields of financial instruments. However, the market reckons it is more important that the interest rates are fine-tuned to the actual state of affairs. If the interest rates are lowered in line with the market expectations, this could have a destructive impact on the economy. If so, it will cause broader pain to the whole community, including markets. If the comments by the ECB president are perceived by investors as more adequate, the US dollar will be wound down to a greater extent. Meanwhile, the euro-dollar pair is trading in the corridor between 1.1022 and 1.1170. Traders are bullish about the euro. The rally will speed up after the instrument breaks the level of 1.1169, and the euro might come under selling pressure after the instrument slips below support at 1.1047. The pound sterling is also taking advantage of the greenback's weakness. The pound-dollar pair is trading in the corridor between 1.2855 and 1.3047. It seems that the bulls aim to hit the targets at 1.3000 and 1.3047. The downside scenario is possible in case the currency pair declines below 1.2939. And that's all for now. We keep monitoring the financial market situation. Subscribe to our channel and see you in several hours. We will take a close look at the US trading session.